Good evening, friends, and welcome to my YouTube channel. Today, our topic is, which is a current topic and very debated and discussed these days, the Silicon Valley Bank. Why did Silicon Valley Bank collapsed? It's a very big question in everyone's mind. To understand the whole incident, which has rattled the banking industry across the globe, we have to understand these concepts. What is asset liability management? And what do we mean by investment portfolio? Concept of mark to market of the securities, rate of interest and the bond prices. What is the relationship between these two? What is the meaning of run on the bank? Run on the bank. And after understanding these concepts, we will proceed to understand what happened to Silicon Valley Bank of the United States. So let us start with this brief introduction that this bank was established in 1983. It was a regional bank in the United States, and you will be shocked to know that as per Forbes magazine, this bank was the best bank for last consecutive 5 years, best bank of America. And it has collapsed just like that. So, what happened? We will understand. Let us discuss these concepts. What is asset and liability management? For a bank, assets are the loans and advances and its investments. Liabilities are all the deposits, rather we do not consider here the capital and reserves and other liabilities. They are also liabilities, but mainly our focus will be on deposits. So for understanding the asset liability management, the bank has to manage the short-term liquidity. If there is a demand from the depositors for the payment of their deposits, the bank has to meet it at any cost. We cannot deny the payments to our depositors. And that is asset and liability management. For this purpose, in our case, Reserve Bank of India has 11 time buckets. They have prescribed to every bank 11 time buckets. According to that, the bank has to manage the short-term liability, and if there are gaps, there are liability gaps, those gaps have to be very well planned and properly managed so that there is no problem in repaying our depositors. In case we deny the payment to our depositors, the trust and the faith in the banking institution shakes, and it results in the collapse of a bank. The bank may fail. That is asset and liability management, which is very important for the short-term liquidity point of view for a bank. Investment portfolio. Every bank, when they receive deposits, they have to make, in India, mandatorily, they have to invest some portion in cash in form of cash reserve ratio. In addition to that, we have to maintain statutory liquidity ratio, and that SLR is in addition to that cash balance which we have kept with Reserve Bank of India. SLR is actually the investment in government bonds and other securities, and this makes our entire investment portfolio. And in this investment portfolio, we have to maintain three categories of our securities. Category number 1, held to maturity, HTM. Category number 2, available for sale, AFS. Category number 3, HFT, held for trading. Now the securities under HTM category has to be held by the bank till their maturity. So they are not treated, or they are not supposed to be subject to the market risk. Other two categories, available for sale and HFT, held for trading, these two categories are subject to the market risk. And what is the market risk? Market risk is, if the rate of interest in the market goes up, the bond prices will fall. Rate will go up, so bond prices will fall, or securities prices will fall. This is an inverse relationship. Relationship. If the rate will go up, bond prices will fall. And what is the meaning of run on the bank? Meaning of run on the bank is when most of the depositors queue up to withdraw their deposits from the bank. This concept or this phenomenon is known as run on the bank, and it may lead to the collapse of the bank, because you have to go back to asset and liability management. Our assets are loans and advances and investments. Liabilities are deposits. If most of the depositors are queuing up to withdraw their deposits, we have to meet the demand immediately, whereas our advances recovery will come in due course over a period of time. So there is a huge gap in between these two aspects. Deposits will be repaid immediately, and assets will come back to you over a period of time. And we have to manage this. But if there is a run on the bank, the bank is bound to collapse. It's not possible to survive without the support of the government of that country or central bank of that country, or both. If the government and the central bank of that country support that this bank should not be allowed to collapse, only in that case the bank can survive even after the run on the bank. Otherwise, bank is bound to collapse. After understanding these concepts, let us understand what happened to Silicon Valley Bank. In case of Silicon Valley Bank, on the basis of the current figures available, the deposits of the bank stood at $175 billion. Their assets, means advances and investment, stood at $209 billion. So assets were far exceeding the deposits, and the bank should have not been collapsed, but it has collapsed. So what went wrong? There are two things very important here. Number one, the Federal Reserve, US Federal Reserve, which is the central banking authority of America, USA, has increased the policy rates from 0 to 4.75% in 10 months. In last 10 months, the rate has gone up, policy rate has gone up from 0 to 4.75%. What is the impact on their investment portfolio? Rate will go up, bond prices will come down. So immediately their bond prices fell too much and they sold in a single day their bonds worth dollars 21 billion dollars at a loss of 1.8 billion dollars in a single day in order to meet the demand of the depositors. And who were these depositors? These depositors in this bank particularly were the startups, the tech companies, the tech HNIs, high net worth individuals, tech HNIs. So they were having their deposits with this bank. But when the news broke that the bank has suffered a loss of $1.8 billion in a single day on their investment portfolio, the startups and other depositors queued up to withdraw their deposits. And finally, these events led to the collapse of the bank. The bank could not survive and it has been handed over under the control of FIDC, Federal Deposit Insurance Corporation, FDIC, Federal Deposit Insurance Corporation. In our case, it is Deposit Insurance Corporation. There it is Federal Deposit Insurance Corporation. And the deposits which are insured will be paid back, and the deposits which were not insured, they have to deal with as per the US laws. Another thing happened that because of this loss of $1.8 billion in a day on their investments, the stock collapsed in a single day about 60%. And this also triggered a sort of run on the bank. And the surprising fact is that KPMG gave a clean audit report to this bank just 14 days before its collapse. Just 14 days before. And another bank which has collapsed just after 2-3 days of collapse of the Silicon Valley Bank is the Signature Bank. US Signature Bank has also collapsed. And KPMG gave again a clean audit report to Signature Bank also just before 10 days of its collapse. Now this leads to all of us to think over that what is the credibility of these rating agencies and these audit firms, particularly in US. They are giving the clean audit report and the bank is collapsing after 14 days. They are giving the clean audit report to Signature Bank and the bank is collapsing just after 10 days. So there is a big question mark on their performance of the rating and the audit companies in US. Now what can be the impact on the Indian banks of this incident, of this event which has happened in the global banking industry space? The impact on Indian bank: we are well capitalized. Indian banks are these days, means particularly in the current scenario, are well regulated and very well capitalized. So here the impact is very little. Number one. Number two, now we have learned how to convert the crisis into an opportunity. In this case also, we have converted, or we have found out an opportunity in this crisis. The startups who are withdrawing their money from the Silicon Valley Bank, they are approaching the Indian banks and they are opening their business and current accounts here in India or even Indian banks abroad to keep their money safe. They are withdrawing from that bank and depositing it with Indian banks. So they are getting an opportunity to garner the dollar deposits and also to invest this money to support the other startups and tech companies and tech HNIs to support in form of dollar advances. So dollar flows to the country may increase and dollar advances to support these depositors which particularly the startups which are feeling the heat of shortage of funds now after this incident. So they need a support and our Indian banking system is providing them that support. I hope the whole gamut of Silicon Valley Bank failure is clear to all of you. So with these words, I conclude my video with a request to you to subscribe to my YouTube channel. Also like and share my videos and press the bell icon button so that you get my notifications in time. Thank you. Thank you very much. I am signing